Hi, folks. Welcome back to Murthy Finance Academy. Today, we will discuss some interesting players from recycling sector. So, the first company which we are going to discuss today is Jain Resource Recycling, which is a recent IPO company. So, but before we start, a quick disclaimer: I'm not a SEBI registered analyst. Whatever the companies we are going to discuss are simply for educational purpose. Please do not consider it as a buy or sell recommendations. So, so the Jain Resource Recycling Limited is hitting a critical operational inflection point where volume-driven scale meets margin accretive forward integration. So as investor sentiment pivots toward the circular economy, Jain Resource has solidified its position as India's dominant non-ferrous recycling platform. For 9 months fiscal year 2026, results reveal a powerful narrative of both operating leverage while revenue grew a robust 38% to 6,438 crores. EBITDA and PAT both surged by a disproportionate 65%, with EBITDA margins expanding 116 basis points to 7%. This scaling is underpinned by aggressive strategic moves, including the Ahmedabad-based Jain CY Circular Solutions joint venture and 25% stake in Kuwait's Abraj Al Khalij. The central question for the street remains: can JRRL sustain its historical 40 to 50% CAGR while successfully navigating the technical complexities of the copper cathode and antimony markets? In a macro environment defined by diminishing ore grades and a staggering 27-year lead time for new copper mine commissioning, recycling has transitioned from a choice to a strategic compulsion. Chain Resources leverages a unique Indian ecosystem advantage, combining cost efficient labor with sophisticated plastic label processing infrastructure that provides a structural edge over regional hubs in Thailand or Malaysia. Positioned as a multi-commodity titan, Jain Resources internalizes byproduct synergies that single metal peers cannot match. Regulatory tailwinds, specifically extended producer responsibility (EPR), are further incentivizing domestic sourcing, which is now 44% of total raw material volume, providing a resilient floor for feedstock security amid global supply volatility. So the company is tracing its lineage to 1953. The modern Jain Resources has evolved into a circular economy unicorn with a valuation exceeding $1 billion. So the company has having a massive processing capacity across copper, lead, aluminum, plastic, and tin. So the company also operates global network spanning 120 plus countries, supported by a 24 by 7 trading desk. So the company is having a foundational zero waste, zero landfill, zero burning mandate that utilizes green fuels and integrated byproduct recycling to minimize environmental and economic leakage. So Jain Resources unit economics are governed by a sophisticated round the clock trading desk that manages LME linked volatility across time zones. So to protect gross margins, the company maintains disciplined short positions the moment raw material is purchased. However, investors must understand the ditch gap, a technical 3 month lag effect between scrap procurement and finished product sale. Because purchase and sale formulas are LME linked, a 1 to 2% formula fluctuation during this 90-day window can create quarterly EBITDA per ton volatility, which we can see in the recent dip from 51,000 to 42,000 in copper, even when absolute margins are hedged. This is a timing mismatch, not a structural margin erosion. So, Jain Resources is executing a dual track strategy to move the needle on both top line scale and bottom line quality. So, its volume drivers are the Ahmedabad JV Jain CY Circular targets a 25,000 metric ton per annum copper output, while the Kuwait platform secures a priority pipeline in the Middle East. So its profitability drivers, the pivot from selling commodity ingots to high purity cathodes, bus bars, and wire rods transforms Jain Resources into a specialty manufacturer. Similarly, the separation of lead antimony bullion via niche technology unlocks value from previously undervalued byproducts. This forward integration increases customer stickiness and shifts the company toward a manufacturing grade valuation multiple. So the company's operational breakdown, if you see the copper lead core, copper, which is contributes 52% of revenue. For 9 months, the company generated revenue of nearly 3,317 crores. The segment is currently transitioning from ingot production to the Unit 3 cathode ramp up. Second segment, lead, which contributes 43% of revenue, generating 2,772 crores in 9 months fiscal year 2026. This segment provides volume stability via the lead acid battery ecosystem. Third is specialty assets. The tin capacity has been aggressively scaled from 4 times to 125 metric ton per annum to 500 metric ton per annum via vacuum distillation technology. So if you see its phase-wise integration of existing roadmap, management is finding phase 1 of Unit 3 internal accruals demonstrating disciplined capital allocation. So it's Jain Green Tech, which is Unit 3, which outputs anodes, cathodes, wire rods, and bus bars. Timeline they have given is Feb 2026 to Q1 fiscal year 2027. So here the company is planning for a capacity of anodes of 800, right arrow of 1600 metric ton per month, and cathodes of 750 with 1500 metric ton per month. So the JNCY circular, which is based in Ahmedabad, it processes copper and ingots. So this will be launching in June 2026 with 25,000 metric ton per annum output. So the next, Abraj Al Khalij, which is based in Kuwait, is a battery scrap platform, which is which the timeline they have mentioned is Q3 fiscal year 2027 with a capacity of 2000 metric ton. Processing includes ROFR. And the last is antimony extraction, which is nothing but a lead antimony separation, which is also expected to phase in Q3 fiscal year 2027 with 100 metric ton per month output. So collectively, these projects are expected to contribute 100 basis points expansion to consolidated EBITDA margins. So the 1.7 times multiplier of PAT growth of 65% relative to the revenue growth of 38% is the clearest evidence of Jain Resources maturing operating model. So the company's volume growth stood at 29.3% with the remainder driven by LME value appreciation. So the company's inventory days also spiked to 90 due to strategic bulk copper tenders and the newer holiday lag in China and Europe. Management has committed to a roadmap returning to this to 35 to 40 days by March fiscal year 2026. So the returns profile, Jain Resources maintains a superior 30.1% ROE. Bank limits were re-availed primarily to support working capital for copper, which has seen 40 to 45% price appreciation. So management is most likely talk less, do more. So management's philosophy is evident by their track record. They projected 20% growth for the period but delivered 38%. Its CMD, Kamlesh Jain, remains confident in maintaining 40 to 50% historical growth, while JMD Mayank Parikh emphasizes the niche technology for antimony as a significant high margin differentiator. A critical but overlooked sourcing moat is the right of refusal, ROFR, secured in the Kuwait deal, giving Jain Resources priority access to high quality scrap. So the company, as the largest non-ferrous recycling platform in India, Jain Resources lacks a direct apple-to-apple peer. Its integration of plastic recycling and zero waste metrics makes it a unique global player, successfully competing against Southeast Asian hubs by leveraging India's specialized recycling ecosystem. So, if you see on a conservative basis, if the growth slowdowns to 20%, margin stall at 7%, working capital remains stretched. In a base case scenario, if the company grew by 40% and Unit 3 commissions on time, EBITDA per ton stabilizes to nearly 50 to 55,000. An optimistic scenario, if growth is being driven by 50% plus growth, antimony and cathodes drive margins to 8.5% plus, then ROE stays more than 30%. So the key risks in this company are the ditch gap, sustained LME volatility, creating formula mismatches between 90-day procurement and sales, execution, potential delays in the technical ramp up of the Ahmedabad or Kuwait facilities, and regulatory discrepancy, a SEBI investigation which led to 25 lakh penalties under appeal. So the company CMD is also called a 10-year-old matter, while the CFO clarified it as a 3-year-old matter regarding a 10 lakh profit. So we need to be cautious in this, though it is immaterial to the long-term thesis. So Jain Resources is no longer a mere scrap dealer. It is a sophisticated global multi-commodity platform. By moving into copper cathodes and specialty antimony extraction, the company is effectively de-risking its revenue from poor commodity cycles and re-rating as an industrial manufacturer. So what are the some key metrics to watch are working capital, whether it is coming back to 35 to 40 inventory days by March fiscal year 2026 or not, and unit 3 execution, phase 1, cathode output by April 2026, and antimony ramp up, successful technology deployment by Q3 fiscal year 2027 are the some key metrics we need to watch out for the next 12 months. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.